to the extent that we can do it in this format. And I think this is an opportunity to ask questions or disagree with me or disagree with each other. And so that you can do that through the chat function if you're more comfortable. You can raise your hand and just chime in. And so I'm more than happy to have this be as conversational as makes sense, right? So let's think about it from here. So this is me. I'm Christian Lundblad, and my digits, as it were, are at the bottom, right? So you can reach me, in LinkedIn, and I'm going to show you a few things today that may pique your interest. And so the stuff I show here is the stuff that is often featured over there. So if this is material that does indeed pique your interest, then definitely connect, and I'm more than happy to do that. So let's sort of talk about what it is I would like to do today. And I thought I thought I would motivate it as follows. So again, at the sort of higher levels of the organization, and so here we're talking about key decision makers, C-suite, boards, if this is an organization that has boards, public company, what have you. Essentially it's the job of the stewards of the scarce resources of that organization to think carefully about the various ways in which they might get whacked, right? Like, that's basically it. So what's going to whack you, right? And what are the things that have the potential to significantly impact value creation or value retention in an organization? And so the way in which we often do that is really just through a cataloging, right? Of cataloging of all the obvious stuff, the crazy stuff, that might negatively affect us, and then we do a bit of conversation from that point forward. So that involves articulating, what's the likelihood of this being problematic, and were it to become problematic, what are we talking about in terms of value implications? Like, how significantly is this going to affect my organization? And an effort like this is designed to be very comprehensive, right? So it's sort of horizontal in the sense that all the different units of the organization have to be engaged. So you can really have a finger on the pulse of all of the different vectors through which problems might arise. It's also meant to be vertical, and that's touching the shop floor, or whatever is the appropriate analog in a different organization, all the way up to to the C-suite and maybe even the CEO themselves. And so what we might do then is have a whole host of different stuff, and then we kind of plop it into a representation like this. And this is from an actual Fortune 500 company that I do some consulting with. I grabbed a handful of the different things that show up normally in a representation like this that would eventually, again, facilitate board discussion and such. You might have 30 or 40 things over there, and all those things are, again, pretty dispersed, right? So we're talking about anything from kind of obvious stuff to financial concerns and liquidity concerns, the inability to satisfy debt obligations, for example, or energy costs, right? All the way down to like talent. And so that's the purview of the HR folks, and that's about retention or succession planning or whatever you might imagine over there, up to crazy stuff like cyber risk and maybe even political risk and the like. And again, none of this is meant to be, there's no illusion of precision here, let's be very clear. But what I'm trying to do here is basically give you a sense of the breadth of things, the dispersion of things that we have to be cognizant of when we're sort of characterizing all of the possible concerns, all of the possible risk considerations that might negatively whack us, right? And so what do we have to do here then? Well, that really involves a pretty comprehensive characterization of things that may not necessarily feel all that close to us. And that includes what I've kind of described so far as the external environment. And today that more or less is, now we got to know things about virology. I mean, who the hell ever thought we'd know anything about that? And we got to know things about how that impacts economic and political decision-making, right? Including shutdown, decisions and the like. And so, so that's sort of what I want to go through today in some sense. It's our job as elevating business decision leaders have a kind of handle on the pulse of weird stuff, things which we may be very close to what we're doing. If I'm a financial market trader, for sure. If I'm in another part of the organization, maybe it doesn't seem it. But in all cases these days, it's really pretty difficult to be too divorced from some of this stuff. So let me ask a question, which is, suppose you were standing at the beginning of this year, where on a picture like this would you put a pandemic?
At the beginning of the year, I would have put the impact to be stronger, but the likelihood to be lower until now.
Correct. So we may revise our thinking going forward about relative probabilities. That's for sure. But that's exactly right. And I actually, that the upper right quadrant here, the parts that are high impact and high likelihood, obviously deserve attention. Clearly, so we have to do things as decision makers, as risk managers, as whatever, in order to mitigate those kinds of concerns. But the ones that actually are particularly vexing are precisely those, right? The ones that reside up here. Those are the ones that are tough to see. They're hard to even envision sometimes, let alone imagine putting any kind of probability on them. So the picture I have in the upper right is the Archduke Franz Ferdinand shortly before being assassinated, which was the butterfly that ultimately started the hurricane that was World War I, right? So, a pandemic we could put over here. If I were, BP, I might, think about, certain risk mitigation with respect to my operations that ultimately became problematic in the Gulf. Or if I were, Boeing or something, I might think about certain kind of decisions with respect to, to airplane, provisioning, what have you. But these are what we would call sort of radical uncertainty. Radical meaning it's just so difficult to sometimes even envision the thing, let alone do anything about it. But we've sort of been forced to live with a lot of these of late, and they're hard to predict. They're deeply uncertain. But the reality is, for organizations, this is where we often experience the most rapid and painful shareholder decline, right, in terms of value. So dealing with those is really, the only way you could even get close to having anything to say about it is you have an organization that allows some out of the box thinking and some, weird folks to say weird things and that you take seriously, right? Like ultimately that's, that's the task in some sense. And we got a lot of those right now, right? So we've got election uncertainty. We've got the continuing trajectory for this virus and a whole host of other questions with respect to emerging Cold War considerations possibly, and deglobalization and the like. And I kind of want to just walk through a few of those, and I'll give you some thoughts, and I'm happy to hear yours as well. And again, feel free to chime in or ask questions or disagree with me or each other. I think that's okay. And if it's a bit of a dangerous invite these days, given the world has become rather political, but I'm comfortable giving it a shot. So let's see how that goes. So here is one view of such what we might call tail risks or kind of extreme considerations. So tail risk here means kind of imagine a distribution of outcomes, and the left tail is the one where you sort of get disproportionately whacked. So this is through the lens of fund managers. So here we're talking about investment management professionals, and they're asked. So B of A asks a whole host of these folks every month a bunch of questions. Many would be only interesting to you if you were in the investment management space. But one that gets a lot of attention that I always find kind of interesting is they basically ask them what scares the hell out of you, more or less, right? So what's the biggest tail risk? And not surprisingly, right at the very top is COVID, of course. You can also see concerns about the election. So this was the last. We'll get an update on this in the middle of November. So later this week or next. So this was obviously just before, and then a host of other things which are a bit more specific to financial markets. But again, a consideration that has lingered on this tail risk survey for almost the entirety of of President Trump's term, which is concerns about a U.S.-China trade war and what all that means. So these are the kinds of things that I'm sort of talking about, at least. So what I'd like to do is to really zero in maybe on three, and then go from there. So again, in the spirit of the external environment and zeroing in on kind of three things that I think have a lot of uncertainty associated with them, I sort of entitled the talk "Certain Uncertainty." We can think about the trajectory for the global economy and the intertwining nature of that with the COVID story. I'm going to force everyone in the room to think for a moment about central banks, which may not seem that obvious to you, but it is extremely proximate to every single person in this room right now, for a whole host of reasons, some of which will be very directly related to business, depending upon what it is that you do. But for sure, nobody in the room is immune from the things that are happening in that part of Washington. And then finally, the policy response from our elected officials, and the trajectory for that going forward, particularly given now that at least it seems we have some election resolution, although we'll see. And then we can talk for a moment, perhaps at the very end, about that China globalization question, right? So what I thought I would do here is first ask you a little bit where you think our economy is likely to go, given all of the craziness right now, a second wave perhaps of a virus, maybe the resolution of some political uncertainty. So take a moment and take a look at that, and then we'll talk a bit about that and try to get a handle on where things might be headed. All right, it looks like the popcorn has stopped popping in the microwave here. So let's take a look and see where you guys are with respect to your thinking. So I've got one comment in the chat, and then a number of responses over here. Disproportionately, more than 2/3 of you are looking for, so this is kind of the alphabet soup of recovery trajectories. So there's a V and U and W and a whole host of others actually that have been posited out there. This one is a W-shaped recovery, possibly some second challenges associated with a second wave. So who responded on that and wants to tell me why?
I can kick it off.
Yeah.
I went W. I think there's a whole, I kind of looked at it from a market perspective. There's a whole lot of positivity baked into the market already. I think if you think about just credit spreads in general, and they're 15 basis points, which is about 1.5% negative excess returns from the tights of the year pre-COVID, which seems like COVID never really happened in the market, with still a lot of uncertainty to go. So I think there's a likely retracement to a certain degree, not to the same extremes by any means, but some sort of rebalancing that needs to take place as you think about, you're going to get into this monetary policy, but as that unwinds to a certain degree, if it ever unwinds, it's kind of dependent on that as well. But there's just a whole lot of things that have been baked in that are positive, not a whole lot of negative at this point, which is kind of perplexing to me.
Good question. So good. That's a good observation. So let's talk about that just for a moment, and then I'd like to hear from some others. So there's financial markets, and there's the real economy, right? And so financial markets, we're talking about the equity market, fixed income, bond markets, that sort of thing. More exotic parts of the financial market landscape, whether it's venture capital, private equity, all those sorts of things. So that's one piece of the puzzle. And on the other side is the actual transactions that we all do as households and businesses, right? So that's what we're talking about, your consumption decisions. We're talking about your firm's expenditure decisions through perhaps capital expenditure or something else, and other forms of expenditure sort of more broadly defined, but actual real economic transactions that are taking place, not paper and paper valuations. Those two things are necessarily intertwined, because the paper that you own as a share of stock is just a kind of capitalized value of future real earnings, real cash flows associated with some operation. But they're not exactly the same. And I think Jake's point is exactly right, which is they are particularly divorced right now in a way, where we've got a financial market landscape that is fully rebounded from the craziness of March and April, and in fact, in some metrics, actually well above where we were at the outset of all of this. And if you think about kind of the nature of the second wave, vaccine announcements notwithstanding, the second wave looks a hell of a lot worse than the first. You got to make some arguments that this is going to be fundamentally different in terms of shutdowns or fatalities associated with it. The therapeutics are better now. Something you got to make some pretty compelling arguments to say the equity market deserves the valuation that it has right now. But let's leave the market aside for the moment, because I'm going to come back to that, and I'm going to try to at least give you my perspective on that. I think that's also really important for every single person in this room, even if you have no relationship at all with financial trading, right? And again, that's very much in the spirit of bullet point number 2 here. Let's focus on the real economy for a moment. So let's think about the actual consumption activity that you all engage in as households, or perhaps as stewards of resources for the organization. That obviously got whacked in the heat of the late spring and early summer, and has been inching its way back. And I'll give you a sense on that. But I think didn't get a single respondent saying a big aggressive V shape, right? So I think that one is clearly off the table, and I agree with the consensus in the room off of that. But what would it take for the economy, the real economy, not the financial markets yet, we'll talk about them, but what would it take for the real economy to sort of get back to where we should have been in the absence of this dislocation? So anyone else that said U or W, because either of those are pessimistic about that trajectory. Let's put it that way.
I mean, if you look at it, I don't live in the financial space. I live more in the manufacturing space.
Yeah.
And what we've seen is, that drop with everyone else, and then it took off. People were spending all their vacation money. The wealthy people were spending their vacation money, and there was lots of business. We're seeing companies hit or supersede their goals for the year already. But then on the flip side, refilling that stock has become harder and harder, because when you look abroad to the smaller components that are being manufactured, they're harder and harder to come by. Yeah. So to produce that, I can already see that slowdown happening. And then you watch COVID going down, ramping up as well. So you look at that manufacturing deficit that we're going into, where most of the existing inventory has already been used and purchased. And then what happens when the rest of the world's also experiencing this sharp COVID hit? Like, when do we see that reemerge into what it used to be? That's what made me choose the W shape, because my experience of 2020 has been that W, and we're riding that up, but you can already see it coming. I'm having a hard time sourcing products from abroad and getting key components that are holding up entire processes and giant transactions. So that's why I went for W. It's more of the real economy. I don't watch the markets like I'm sure some of the financial people on here do, but I watch purchasing activity and fulfillment activity, and that's where I'm seeing the W, or assuming the W, I should say.
Fair enough. So I agree with you fully that there's some very unusual byproducts of this particular episode, and some acute supply chain disruptions, that's for sure. So even beyond that, though, so suppose you could access what was needed to produce. I guess the next question that I would ask is, is the organization, your organization, others in the room, fully engaged in the kinds of new initiatives, capital expenditure projects and such that you look, if you're on Zoom or something, that's fine. I get it. That's full steam ahead, right? But for others, I think there's at best a kind of wait and see, maybe a risk paralysis, and in some cases, the revenue decline has been so catastrophic that it's it's impossible to move forward. And those are in larger organizations. If you take smaller organizations, which I presume some of you probably represent, that's 50% of our economy, and about 50% of our labor force, for that matter. And that part of our economy is just disproportionately whacked right now. I mean, just whacked. And so there, that's where you really do see, at the worst of all of this, revenue declines that approach in some cases minus 90+%. All of this is just getting in the way of kind of moving forward in different interesting ways. And so let me sort of give you some thoughts on that, and then I'll come and actually look at Brandon's point in the chat, because you raised an interesting one that I think is worth touching upon. So let's take a look here. So this is for the whole world, actually. So this is the entire global GDP trajectory under a host of various scenarios. And again, when I say sort of certain uncertainty, this is really what I mean in some sense, which is not that any one of these scenarios is likely to be right. I mean, I suppose one is going to be closer to the reality as it transpires than others, but it's really a reflection of a number of different possible scenarios that it's pretty difficult to get your mind around, right? So, and when we're talking about, a $70 trillion global economy, which is what we're talking about across the entire globe, these trajectories are real money, right? I mean, we're talking about, trillions and trillions of dollar equivalent. And so, the kind of lighter Carolina blue would be this particular organization's baseline. Notice, even under their more benign scenario, we sort of get back to where we were, sometime next year. And it takes us, years to even start to approach kind of where we might have been in the absence of this dislocation. And then the more concerning scenarios that they articulate are what they call sort of more pessimistic versions, where the virus becomes more problematic and induces additional shutdowns, which I think we would have to, wherever we sit on that in terms of political, economic, whatever thinking, I think we just have to put an elevated probability on the likelihood of that happening. I mean, in fact, that's one lesson that I would give all of you, is everyone in the room obviously has very different political leanings and such, but our job is to be as dispassionate as possible and just understand what are the range of scenarios that could come to pass and adjust accordingly, right? And so to the extent that we've got to put some hard to pin down probabilities on these other ones, we got to think what the world would look like in such a setting. And these all collectively mean really different things for the nature of household consumption behavior, and then how that bleeds through into corporate earnings and the ability to retain some of that and do something interesting in the form of capital expenditure and such. And so this is it's really stunning. And this sort of gets to the question that Brandon raises here, which is how does this compare with with the 2008 crisis, which took years? I would say at its outset, we hoped the V-shaped aspiration that existed earlier was a hope that this would look very different from your traditional recession, and in particular one like the financial crisis. And let's understand why for a moment. This was truly external, right? It was just a shock, as it were, that just kind of comes from outside any of our own decision making. There's no bad decision making, excess risk taking, excess leverage, anything like that brought this upon ourselves. And that was the story of the financial crisis in earlier time. We sowed the seeds for that eventual collapse. And when you do that, you have to pay the price for that misallocation of resources. You've got to work your way through that challenge. and that's very costly. It's painful, and it involves a lot of consequential reallocation of resources, and that's really 2008 was a very grand example of that. Here, if we just got whacked and had to shut down for a month and then went back to normal, it would have been extremely painful during that month. But I think generally things would have returned rather to the way in which they were before. Here is what's different in this case, which is the longer this lingers, the more it starts to look like a run-of-the-mill recession, because the knock-on effects start to become consequential. So economists have some fancy language for this, but I think the most apt language is scarring. Essentially, what you get over here is you get folks that start, imagine all the small business employees that I alluded to before, as they start to get disconnected from their places of employment, and you go down to Franklin Street over here in Chapel Hill, and you start to see a lot of places that are disappearing and boarded up. It's really hard to put Humpty Dumpty back together again. And so the longer this lingers, what you start to get then is the same kind of thing you get in any recession, which is sidelined resources that it's hard to re-engage. And so sort of to answer that question or make that observation, I think it might not have been the case if we could somehow magically have solved this medical issue. But as this has lingered now already so much longer than we thought, and now I think the probability of additional shutdowns is elevated, which would necessarily engineer a second dip. That's where you would get the second V of the W. Would be it's going to start looking a bit more like that. Questions or comments on that? Where's this most acute? Who's hurting the most as a result of this? Small businesses, and in particular, their employees. So let's take a look at that for a moment. So let me roll you through straight to here. So here's the state of our labor market, and this picture hides, or in some cases unearths, some interesting realities, right? So if we went back to before all of this hit in February, the unemployment rate, that's the top line, was 3.5%, which was an historical low. I mean, we basically hadn't really ever seen an unemployment rate like that, really since the number existed, for the better part of its history. Of course, we have this dislocation, we get a double-digit unemployment, and now we've been working our way back down, but that's starting to plateau in some sense. So we're making progress, but like the rate of progress is slowing, right? And so that's really consequential for lots of folks. Most disproportionately, leisure, accommodation, other service industries, obviously, airlines and such, and very, very different experience for for folks that have been able to continue to work and be productive in the Zoom setting, with some important exceptions, which I'll mention in just a moment. So actually, some people have hypothesized that the real recovery is a K-shape, right? So some have enjoyed a very different and robust new set of opportunities as a result of this dislocation, and others are significantly struggling. And so it's kind of like a bifurcation of the American experience in some sense, based on what's going on. And I think you can see that. I mean, we should be honest with ourselves. Like, there's kind of a narrative out there that we're all in this together, and I think ultimately we are, in the sense that the resolution of this will require some coordinated American and human effort, frankly. But there are different parts of our society that are disproportionately being affected, and it's essential service workers and others, and you can see really big disparities here, even in the October numbers, in educational along educational dimensions and along various ethnic dimensions. And I think one that's really quirky, but I want to tell you why, is look what's happened to the split between men and women, right? So something interesting you see over here is that number sort of gets higher for women during the worst of it, and then comes down more sharply in the end. And that's a little bit of a mirage. And the reason it's a mirage, and I'm sure a number of you will understand when I tell you why, is what we've learned is that the consequences of this and childcare and everything else is disproportionately hit women relative to men in America. And what that's done to this number is actually a greater number of women have left the labor force, right? So what does that mean then? They're actually not in that 6.5% calculation. So it actually is arbitrarily lower than it really is in reality. There are a number of women that have exited, and so they don't get counted. And when they exit, it actually looks like some folks that are maybe struggling are just sort of disappear, right? And so you get a weird perverse thing in that number where it actually goes down a bit. So there's a lot of weird stuff kind of buried in over here. But I think the one thing that I really want us to appreciate, regardless of those kind of within American differences, is like the trajectory has been solid, but the rate of trajectory is slowing. And there's in lots of different ways we can see that. So here's another one, which I thought would be kind of a cute representation of what I have in mind. So one of the challenges we've had as policymakers, so sorry, there's a question from Brittany. What did you want to ask there?
I was just curious what the U-4, U-6 total versus broad.
Okay, great. Good question. So the numbers that you see reported, every month is one of 6 numbers that are actually calculated. So that's kind of the standard unemployment rate. What that doesn't fully reflect, and the reason the second number, what's called the U6 number, is larger, what that doesn't fully reflect is, of course, levels of slack in the labor market that are more nuanced, right? So let me give you an example. You're working part-time, but you'd like more hours, right? You're going to be counted as employed. And in the U4 number, that's going to count you as employed. But that's economic slack, right? So it's not that you're choosing to do it because it's the best for your schooling or your family or whatever. It actually means that there's some economic activity that's being left on the table for some reason. And so that more subtle representation finds its way into the U6 number. Or the one that I mentioned before, where you have people leaving the labor force. So if there's some women that are leaving the labor force, the U4 number is going to be a little bit weird in that sense, because they're just going to leave the calculation altogether. The U6 number is broader, and it does reflect that kind of, that sort of discouraged worker or worker that's leaving for some other, economic reason. So the number is definitionally going to be higher because it's broader, but it's also a number that gets some attention to sort of appreciate the degree to which there is some other forms of slack in there. And again, you can see that one has come down as well from its peak. But even there, the rate of improvement is slowing. And there's lots of examples of that. So I'll show you 2 more. So here's one, which is kind of a cute idea, but it's actually pretty telling, right? So one of the challenges we had in assessing, like, not even where we're going, but just where the hell we are, right? One of the challenges we had was, figuring out what was going on, like, in real time. And so one of the interesting things is we were able to harness, in the heat of March and April and such, new forms of data that gave us some window into what's going on in terms of economic activity. So I'll show you this one, and then I'll show you another one just on the next slide as well. And what's happened now is that, Bloomberg and others have been kind of collating and collecting, curating this data and presenting it in what they call things like real-time economic trackers. So here's one, like, go to OpenTable. Any of you want to go and have a reservation for dinner somewhere? OpenTable now has, like, this huge data set of what's happening in North Carolina, what's happening in Chapel Hill, what's happening in Denmark, all kinds of other countries where they have their reservation data. And so what you could actually see in relatively real time, like week by week, so that's pretty close, is you could see what was happening to restaurant reservations. So here it is. They literally went to minus 100%, not surprisingly. But here's something I want you to see, and it's in the spirit of what I just said, which is the recovery is obvious, but the recovery is also plateaued to some degree, right? So there's a bit of that. And that's where we are right now, even before talking about a second wave, is we've had a robust recovery in lots of interesting places, but the rate of that recovery has started to slow, and you're seeing something of a plateau, right? Let me give you one more example, and I'll be happy to take some questions. So here's another one that we've built over at the Kenan Institute. So the Kenan Institute is if you get a chance to come over to the McCall building, that's right next door. That's our think tank that's affiliated with the business school where a lot of the academic research and such takes place. And we were struggling with this same question, which is like, how do we measure what's happening in relatively real time? And so we built an index of essentially the unwillingness or inability of consumers to engage in non-essential economic activity. So not necessarily grocery stores. We're focusing on, restaurants and anything else that would be deemed sort of non-essential. And how do you measure that? Well, you can measure things like bookings. You can measure credit card swipes. Is that happening in a store or is it happening online? You can measure foot traffic. So everybody in the room now, your phone knows where you are and folks are collecting that data. Maybe that makes you feel uncomfortable, but the reality is that's happening. And so we built this measure of what we called kind of consumer consternation. It's about the inability or the unwillingness of consumers to engage in non-essential economic activity. And we will not get to that full recovery in terms of the economy until you're willing to walk back through the storefront, until you're willing to go and sit in a crowded movie theater or to go watch the Tar Heels play or something in the Dean Dome. Until that happens, we're going to be stuck. And so there's two things I want you to see over here. So this goes up when there's more consternation, there's less willingness to do it. You see a significant improvement, but again, a kind of plateau. So the plateau is very, very uniform. It's all over the place. But there's one additional thing I want you to see here, which is if you look closely, you can see the dotted horizontal line that reflects the stay-at-home order here in North Carolina. Consumers were starting to significantly pull back from their economic activity well before the formal stay-at-home order, right? So as we think about lockdowns and the efficacy and the challenging trade-offs of that, what does that mean for other, not just the economic costs, but other concerns for anxiety and depression and drug use and all the other things that we now understand are correlated with this. Those are challenging trade-offs. And maybe it's the right call to do it if the virus starts to get bad enough, and that's a good and healthy debate to have. The reality is also this, which is we as humans became increasingly disinclined to engage in some of this activity well before we were no longer allowed to. And so again, even if we just let it run sort of Sweden style, right? We're not going to get back to where we were until we all feel safer and are safer. I think that's just the human reaction. And so these are the sort of subtle things you learn when you can look at higher frequency, more frequent data, as opposed to the lower frequency data that's often in the government statistical stuff. Questions or comments?
What data did you use here? You mentioned credit card swipes. But...
Yeah, so actually you can go to the link over there. I encourage you to do it. So one of the things we did is create a big data dashboard there that has all of the COVID stats. So you can see it for North Carolina. You can see it for the US. You can see it by region in North Carolina. So the focus there was really on making a kind of contribution to our state. And then also information on economic activity, as well as other things I mentioned, like anxiety and depression and other things that are being collected with some interesting kind of real-time pulse survey stuff as well. And so in terms of the economic activity, it's credit card swipes, it's geolocation data, so where are you actually walking around with your phone? It's things like the restaurant bookings, and then a few other things like that. And so it's pretty interesting to kind of harness novel data to try to see what the heck is going on at a higher frequency than you would learn. I mean, look, GDP data comes out every quarter, right? That's really important data, but it's not very timely. So these data give you a little bit more refined window into what's going on. And so like the cool thing is the world we live in now is these kinds of data are pervasive, so you can get them from all over the place, right? Now, you may not be real comfortable with geolocation data, but it's out there. It just is. I don't know what else to say. Other questions?
Yeah, hi, I have a question. Now UNC is obviously in North Carolina. Did you guys look at any other states? Novel data for a novel virus, but did you look anywhere else, and did it not trend in the same way that the entire United States did?
Yeah, you see very similar trends, and it's highly correlated with explosions in the virus timeline. And then others have also done similar things in Europe, and you see similar kinds of patterns. So this plateau effect is pretty widespread, and the sort of unwillingness to engage in certain kinds of normal behaviors also is pretty pervasive as well. So it's not unique by any stretch to North Carolina. That's those are the interesting findings, I would say, not only of our own work, but also of work that goes on in other parts of the world that have found similar kinds of patterns.
Gotcha.
Yeah, so you can actually you can Google, if you Google OpenTable's stuff, like various folks have pictures like this for all different parts of the world. It's pretty interesting. So you can check it out.
I think it would be interesting. I know that for the unemployment statistics that you showed, it was only by quarter, I think it would, that you shared.
That's by month. I just highlighted some. So
February.
February.
Oh, June. Yeah, I was looking at June. Well, because you look at June and it's very high compared to February and October. But then when you're looking at the other graph that you're showing, the peak I think was in April.
Yes, in terms of that's correct. So you get the stay-at-home order sort of kicking in late March, and then there's some gradual liberalization on that, relaxation that takes place. And remember what was happening. And so let's get to that. Let's talk a bit about that, and that's a good segue to where we're going. Remember what was happening at the time. So we had two different government organizations at that time that were throwing all kinds of effort to steward our way through this challenge, right? And much of that effort was expressly with the intention of keeping laborers attached to the firms with which they were, and so if you might remember, like the paycheck protection part of that was part of the CARES Act. This was expressed relief or help for small businesses to try to essentially access, kind of more or less a bridge loan, to then be targeted to assist the covering of their payroll. What happens over time is some of those places can't survive. Some are don't access that funding, and as time rolls on, you also get some of that funding starting to roll off. So I'll talk about that in a little bit later. But some of that starts to roll off, and so that's where you start to get the spillover into what looks like a more normal recession. So like numbers like this look very different in Europe, where they were able, just because of the nature of sort of social provisioning and such in Europe, it's not really a value statement one way or the other, it's just a fact, that they were able to keep the unemployment rates a bit lower because they were able to sort of lock in laborers for longer. And so that it's actually, as this starts to take off, that's where it's hard to put Humpty Dumpty back together again, as I said before. Like if we could have had folks attached longer, and then we were able to sort of open in the way that I think all of us were aspiring to when we imagine what the virus timeline might look like originally, then you might not have seen this sort of bleed well into summer and even into today. Again, as I said, it's come down significantly, but the rate of growth is really slowed. And I fear we may have, again, a tick up as we get into the latter part of this year and the early part of next, if we have to, again, impose some shutdowns, particularly if those shutdowns aren't accompanied with some additional federal stimulus, which is kind of what held things together at the craziness of this, this late spring, early summer. Yeah, Andy.
So just a question. So you're basically saying that you know, how consumers feel about going out and tying that to transactions and to the economic activity. But there have been so many limitations to what consumers can do and where they can spend a discretionary income. I mean, even with restaurants, there's caps. There's you know, amusement parks, entertainment venues have all been closed or limited severely.
Yeah.
So is it how people feel? Is it limiting? Is it really a reflection of how they feel or what they can do? And not to say that it's wrong, they can't do it, but
no, right. You're exactly right, Nate. So the first order of effect unambiguously is when you shut down the economy, you shut down the economy, full stop, right? And so when you impose restrictions and you liberalize those restrictions and they are partial or what have you, you're obviously impeding the extent to which it could go back to where it was, even if everyone wanted to. I think the lesson that I wanted to convey, in addition to that, which is clearly first order, what's more subtle, I think, is that we saw a significant reduction in this kind of activity before you weren't allowed to. So that was already manifesting. And then the second thing is you have a pretty significant degree of variation across the United States in these restrictions. And so you have kind of a nice testing environment where you can see. And what you see is, you know, in any place where COVID spikes are taking place, whether they are relatively restricted or not, relatively to one another, you still see then a slowdown in this kind of economic activity. So there's definitely, there's an imposition component, which is super important, but there's also a psychological component over and above that. And so I think until we get a full handle on this thing, there's going to be some subset of folks that are just going to be relatively disinclined to engage. And that's going to be a problem for us to have a robust, full economic recovery, right? For sure. Let's talk about the policymakers here for a few moments, because I really want us to appreciate like the magnitude of how these folks stepped in and what might be the possible consequences. And we can come back to your first point, Jake, that you raised at the outset. So obviously, number one is the central bank, right? So that's our monetary authority here and in other parts of the world. And so they manage interest rates, they manage money creation, all sorts of other things. They have a job, which is to try to help in situations like that. So if there's you know, huge degrees of unemployment or prospective unemployment that's brewing, they're going to step in and try to help. And they did, right? So here are, you know, 4 major central banks around the world. The United States is in red, and the others are in other colors. And this is the interest rate that they set as policymakers, right? So their intention here, when they lower these interest rates, as you can see at the end of this period for 2020, when they lower those interest rates, they're trying to induce you as a household to engage in a purchase that you wouldn't otherwise. Or they're trying to engage you as a business decision maker to take on an initiative or a new laborer or a new capital expenditure or something that you wouldn't have otherwise done. They're trying to induce and stimulate economic activity that would not have otherwise happened. And that is pretty stunning in the sense that we're talking about basically zero interest rates, again, all over the world. And I think most impressively, the Federal Reserve has signaled very transparently that they will keep this interest rate at zero until 2023. They told you that now, right? In September, Powell said that. It's amazing, right? Now, this interest rate is only one of many, but it bleeds over into all the interest rates that matter for everyone else. So the blue is your mortgage rate. The dotted black is your organization's borrowing cost if you're issuing bonds to raise financing. And the red is the federal government's borrowing cost if they're trying to shore up their budget deficit by borrowing, right? And so the important thing I want you to see is, like, right now, interest rates are phenomenally low, historically low for the United States, particularly some of them. And so what does that mean? It means your firms can now do things that you perhaps couldn't have done before, despite the challenges of the moment. I would advise you all to refinance if you haven't already, right? And it also means your federal government can borrow for free. For free. That's basically what they're doing here. So the federal government borrowing cost is almost free. And it's absolutely stunning. But it even bleeds through in other ways. Like if you're selling product where your customers are buying that on credit, again, that means their calculus has changed now, and that should change your thinking about the nature of this market. It's really stunning the extent to which this has flowed through and created such a low interest rate environment. And that's not all they've done. Let me show you this, and then I'm going to ask a question. So not only have they set the interest rates to zero and then driven down all these other interest rates that matter for real economic decisions in the economy, but they've also printed money, just outright printed money. This is the modern printing press right here in this picture, right? That's what it is. So the red is the Federal Reserve, the blue is the ECB, that's the European Central Bank, the black is the Bank of Japan. These are all in slightly different currencies, but I just want you to see the delta here, right? This is several $1 trillion worth, or that equivalent, of new money printed. So all the chips are on the table. Zero interest rates, money printing. If I just told you this, what would you worry about?
Inflation.
Yes. Do we have any? None. Zero. There's really no inflation. It's very low. In fact, during the craziness, there was actually a bit of deflation. How could that be? I mean, if I told you, look, outside my house, I'm just going to have a helicopter, I'm going to start dumping money, what would you worry is going to be the value of that dollar? You're going to worry that it's going to be significantly eroded. So why hasn't it? Are we doing anything with those dollars? Are your firms? Are you as households?
Everyone's sitting on it. Everyone's sitting on it.
Correct. I mean, that was your earlier point, Andy. In some sense, like we're choosing not to, which was my point, or restricted from doing it, which was your point, which I acknowledge both are true. At the end of the day, there's a lot of non-essential economic activity that's not happening. Firms are relatively sidelined in terms of their capital expenditure plans right now as they wait and see. So here's a really fascinating picture I want you to see, which is the extent to which our dollars are moving through our system. So this is what's called the velocity of money. It's a fancy term for basically that. How quickly is money moving through the system? And you can just see, first off, it's been, that velocity has been slowing since the financial crisis. Why? Through that whole time period, and this gets to Brandon's earlier point about sort of a slow recovery, there hasn't been a lot of transactions. Households have been relatively sidelined even during that whole 10-year, 12-year period now. And so too have firms been disproportionately disinclined to engage in CapEx. And now, like, nobody's doing anything. So it's just an amazing decline. So here's the thing, which is if the money's not moving, it's not going to be inflationary, just by its very nature. That's number one. But is there inflation risk? What would have to happen for that to be a problem? The money's out there.
Demand.
Yeah, so the irony is if this vaccine really takes off, or its successor or some other version or whatever, is we may actually start to experience some inflationary challenges. For the moment, we have to be intellectually honest. We have seen none, and this is the reason why. But nevertheless, it's pretty stunning that we simply haven't seen. We haven't seen it, but that doesn't mean it couldn't manifest. And so that's a point I want you to acknowledge. Now, while we haven't seen much in the way of consumer inflation, what kind of inflation have we seen? So I'll come back to you, Jake. What inflation have we seen? That's your question from before.
Valuations.
Yes. So here's our stock market. Here's a valuation ratio that just measures how expensive our stock market is through its history. And other than the dot-com era, of the late 1990s, at least based on this valuation ratio, which is just one. It's just measuring how the price of the market relative to the earnings that it's generating. This is a very expensive market, right? This is the express result of the Federal Reserve. So I want to make a pretty clear point on this, because this matters for everybody. And then we'll talk for a moment about fiscal policy, and then we'll wrap up. So this matters for everyone, because this is your 401k, right? This is your pension plan, what have you. Stock market valuations are very high, and that's true through most of the world, right? So the red parts here are the ones that have kind of elevated price earnings multiples, and other than like Russia and a few other emerging economies, you can see, and certainly all the industrialized economies plus some other emerging are pretty expensive, right? Why? Well, we've printed all this money, and maybe it hasn't gone into fueling transactions, but it has found its way into bidding up asset prices. And the same thing is true if we go back here. Bond prices, which are just the inverse of these interest rates, are also super high. And so is everywhere. Real estate, maybe a little less now because of COVID, but generally real estate's been expensive. Private equity, venture, all kinds of other more exotic, pockets of the investment management landscape. And so the challenge for everybody here is the following. In a low interest rate world like this, where asset valuations are exploding, it's difficult to find places for you to build your nest egg. And institutional investors, pension funds and the like, UNC endowment or whatever, they have been actively ratcheting down their long-run return expectations as a result. Many of them have to fully disclose what their return expectations are, and they've been ratcheting these down. And unfortunately, whether you're managing money through that vehicle or not, everyone in the room is managing money for your own retirement. And so your 401k, I think, has to have a more realistic forecast for what returns are going to look like over the kind of horizons that you all are talking about for your own retirement. At zero interest rates and massive valuations, it's going to be difficult for us to generate compelling returns. Now, that doesn't mean we can't do the best we can. We can. There's certainly lessons to be had, but we also have to be intellectually honest with ourselves. And that means in order to build that nest egg, we have to have a savings level that's commensurate with the times. And that's like the least sexy thing I could tell you tonight, but that's really important. Right? It's really important because the earnings generation that we're going to get from there, the returns are just going to be muted. And that is the express consequence of our central bank. So the central banks of the world have been trying to help in one way, but there's a kind of de facto tax, and that tax is on the long run savers of the world. And to the extent that everyone in the room has a retirement aspiration, that's you. One more thing I want to talk about on the fiscal side, but any questions on that or commentary?
Hi, I'm just curious what you think about FANG stocks, especially in terms of like your 401k investment.
Well, they're expensive, right? I mean, so the tech space is the place that's the most expensive. Now, what's different between now and the late 1990s is those internet stocks were kind of mirages. They were lottery picks, right? They didn't have any earnings associated with them, and so they were aspirations about what might come to pass. And indeed, some of them did phenomenally well, and many of them fell by the wayside. What is true over here is that the tech stocks of today have legitimate earnings and have obviously done very well from a true fundamentals perspective in this episode. So the question is it's not really a lottery anymore. It's what's the right price, and those are very expensive right now. So I'm worried that some of that space is expensive relative to the earnings profile that you're going to get as a consequence of the ownership, right? Now, I don't have an easy answer for you for where else to go. And so the reality is a nice, well-diversified portfolio that would mirror what the institutional investors do, UNC endowment and others. Every pocket of that is pretty pricey right now. It just is. And that's so if it's outside of FANG, where else in the public equity market, or if it's in private markets or in fixed income, or you're looking around the world, emerging economies or what have you, they're expensive. Some more than others. There's some relative choice, but the markets of the world are generally pretty expensive right now. And so the consequence that I want you to all internalize is that means we got to be realistic, and that means we got to engage in the churn, the hard work of building via savings. Let's talk about one more thing, and then I'll wrap up. So the third piece, the last one, is on the fiscal policy side. So the monetary policy authorities conduct the interest rate policy and money creation. The fiscal guys, that's the taxing and spending authority of our country. Here in the United States, that's Congress to legislate, the president to execute. And here is a measure of the level of indebtedness around the industrialized economies of the world. So think US, Canada, Western Europe, Japan, Australia, New Zealand, those sorts of countries. And what you can see is relative to a more than 100-year history, our levels of indebtedness as a fraction of our economy are approaching, if not now finally surpassing, the levels that we saw in World War II, which was as aggressive an effort as there's ever been from a financial standpoint in our history. And the pandemic is associated with a huge chunk of that. This was an express choice, right? So we have an express choice here to try to engage in economic activity, to induce economic activity that otherwise wouldn't happen. This is the CARES Act and everything else, right? So here in the United States, this is what that looks like. So in 2020, if you think about all the things that make up the federal expenditure budget, whether it's paying interest on debt that we've already issued, whether it's the defense budget, whether it's the mandatory outlays in the form of various promises that we've made to ourselves as Americans, different entitlements, if you want to call it that or not. That 11% of GDP is all the CARES Act and the unemployment benefits and everything else that we've done. That's just stunning. It's absolutely stunning. But what's most interesting here is, I guess, a tension that I want to point out. Number one, as a consequence of this elongated exercise we're all living, plus the possibility of a second wave, I think one of the things which is incumbent upon Congress right now is to come out with an additional source of stimulus. And what's interesting is there's no political disagreement at all about the necessity for additional stimulus, none whatsoever. The disagreement is about magnitude and priorities. So the Democrats want over $2 trillion and they want some funding going in particular places. The Republicans want about $500 billion and they want funding going into both places. But they both agree on the importance of additional support for Americans who are unambiguously suffering in all of this. My hope is now that we've got some, at least maybe, some resolution on the election, we'll see, there'll be an opportunity to move forward. If there's not, then this probably won't happen in the lame duck session at all. And we wouldn't get an additional degree of support into well into late January, early February. And that's not going to kick in terms of helping folks just because of the nature of the delays and such into March or April. And that's, in my view, just unacceptable. That's not even a political statement because, again, everyone largely agrees that additional support is required. That's one side of the tension. The other side of the tension is ratios like this cannot go on forever. They just can't. And if you look at, like, even when the pandemic is presumably long behind us, at least I sure hope so, by 2030, here's a forecast for kind of where we're going to be as Americans and as our government. And the government is basically going to be spending the better part of its resources on Social Security, healthcare, and interest cost on previously issued debt. And as just to give you some reference, like for all of the conversation about the size of the defense budget, whether you love that or hate it, the level of interest cost is sort of forecasted to approach that. It's amazing, right? And so the questions are like, how does this end? What leadership is required to get some progress over here from this particular perspective? And I think in the absence of doing anything, and again, this is not an excuse to not move forward today. Our job as citizens and the job of a government is to help when needed. That's its role. I mean, that's the compact that we sort of sign with one another. And so there's no sort of fiscal conservative argument about not helping right now, but that doesn't mean that a view on fiscal responsibility doesn't have to reemerge. And I'm not sure how this ends, and pictures like this are problematic, right? And so if you think about sort of the risk map that I showed you, what's the probability of the government running into real problems in financing itself? I think relatively low. But is the probability zero? Certainly not. And risk management, careful risk management, is not what do I think is going to happen. Again, it's what are the scenarios that I have to properly internalize into my decision making so I can do a better job of allocating the scarce resources in my organization. So let me leave you with this. And then I'm happy to hang around. If you need to leave, that's fine, or I'll also hang around and take additional questions. So again, all of this may feel daunting. That's not the intention, actually. It's not, you want to go have a beer or a cocktail afterwards, I understand. But actually, it's quite the opposite. We ought to have our job as stewards of resources and leaders for our organization, and as you grow up into those organizational responsibilities moving forward, is to have quite the opposite, actually, a sober appreciation for the external environment and how it impacts what it is that we're tackled with doing, right? So paralysis is not acceptable, right? It's not. And in fact, inactivity is the worst risk-taking that there is, because you are taking a risk when you are paralyzed, and you're presuming that everyone else is going to be equally paralyzed, and there's nobody against whom you're competing that is not going to have the courage to move forward. And yeah, maybe they screw up, but maybe they also succeed, right? And so that is the least strategic risk-taking you could do, is to allow these kinds of daunting external environment problems to breed a sort of paralysis or inactivity, and today is no different. So I'll leave you with these three questions, and then I'll finish. So number one, I would actually say quite the opposite. So again, in MBA sort of conversations, there's a lot of discussion about strategy and developing strategic objectives and thinking about what to say no to and what to say yes to and that sort of thing. But the other side of that coin, this is sort of what I'm emphasizing here, is risk-taking. So the question I have to ask myself is, am I taking the right risks to have any hope of meeting the strategic objectives that I might articulate or develop with my team? I have to take risks in order to have any shot. And in fact, a quantity question is there too. Am I taking enough? If I bury my head in the sand and succumb to the paralysis instinct, then I have zero hope of meeting my objectives, period. And then finally, and here's a more nuanced question, but I think it's one that's quite important, and only you can really sort of tackle in the context of your organizations, which is like, maybe I also have, in the context of my industry, in the context of my kind of competitive environment, I may have some sort of advantage to take a particular type of risk that the others against whom I'm competing can't. And so as a consequence, then I would say that's a conversation that you may want to have, or you may want to think about degrees of resilience that you can bake into your organization if you think those against whom you're competing have a similar kind of opportunity. So there's this sort of old quote that comes from JFK. I'll kind of paraphrase it, and he's talking in a different context, but it's like, hey, look, every course of action is associated with risks and uncertainties, but there's nothing that is sort of as essentially non-strategic as the comfort of taking no risks at all. And so, like there's another great quote, which is like, there's a ship that is in port and it's awfully safe. But that's not what ships are for, right? That's just not. So with that, I'm happy to hang around and take additional questions, or you can ask Kara any questions you might have of our program. And otherwise, if you need to leave, for sure, you can jump off. Thanks very much, and happy to share some thoughts. And I definitely encourage you to check out my LinkedIn page and go and check out what we're doing over at the Kenan Institute in terms of our kind of COVID economics discussion and our data dashboard and some of the other stuff over there.
Thank you.
Thank you.
Thank you.
I do have a question on the consumption consternation.
Yeah.
How does seasonality play into those numbers? If you're to forecast that out, we've seen summertime, better weather, better opportunity for outdoor events, things where consumption can happen. If we project that into the winter months, do we expect that to rise back up?
It's a good question.
How are you thinking about that?
The reality is the way you deal with seasonality from a statistical standpoint is you got to have a lot of data over a lot of different seasons. It's just sort of the reality, right? And then you can kind of detect patterns that are just associated with that. So obviously, if any of you are in retail, there's Christmas stuff and all that sort of thing, or there may be other seasonalities associated with driving months, if if we're talking about energy or something like that. Then you can identify things that really aren't about particular economic episodes. They're just associated with predictable seasonal patterns, and you sort of correct the data for that. And then you can kind of focus on the residual, kind of what's left over once you've stripped that stuff out. The reality here is we don't have a long enough data series to do it. So we've never had access to geolocation foot traffic like that, right? Like that's kind of new. I mean, what's really quite interesting is those are private sector firms. So the credit card swipes, those are pay merchants, right? Or OpenTable, they have all this data, but they don't have to let it go, or any of these other sorts of things. So what was pretty interesting is sort of in the craziness of the moment, a lot of these data aggregators that were they're not even data aggregators, they're firms that were aggregating data as a consequence of their business. We're releasing this to economists to play around with to help. It was sort of a bit of an altruistic thing. Now they'll probably commercialize that going forward, right? But so we kind of got it in real time, and you can see some of the patterns, including the ones that I mentioned when I was answering Andy's earlier question. But to really identify that stuff and to clean up seasonality issues, we need a lot of cycles so that we could see what's what in some sense. But for sure, this would exhibit some seasonality. There's no doubt. Other questions or comments?
Can I ask a question just about the program?
Yeah, please.
With COVID and obviously its impact on everything. I mean, what's the impact for the weekend classes specifically on the portions that were, designed for in person?
Yeah, absolutely. So I can talk a little bit to that, and then Christian, if you want to add on how you've kind of pivoted during this time as well, you can. But our goal is to be in person in February. Our orientation will kick off February 7th. So the first part of that orientation week will hopefully be in person, with the second part being virtual. And then our goal is obviously to have everybody on campus every third weekend following that. The beauty of this program is being at the Rizzo Conference Center. So it's 50 students. You are kind of, off campus. So it's not like being in the business school where you're having to factor in full-time students and undergrads and all of that. So with 50 students, it's a big enough space to where we will be able to socially distance, but we are pushing to be in person in February. Obviously, that's all kind of still to be determined. Christian, I don't know if you kind of want to touch on what class has been like virtually for the past few months. Although,
sure. I'm happy to. So I have administrative roles where we talk about these sorts of things, and then also I'm teaching as well. I think Kara's exactly right that we've got we have some degrees of freedom as a result of the Rizzo Center and its kind of sort of sequestered nature that is not true in the McCall building in the same way or main campus. So I think to the extent that we're going to try to push forward as we and other professional schools at UNC are likely to do in advance of the undergraduates, there's no dorm issues, there's none of that craziness, and so I think we're gonna be able to try to figure this out at a venue like Rizzo that's going to be much easier. So I'm reasonably optimistic that if it's going to pull off, and reality is there's some uncertainty, if it's going to happen, it's going to happen there. So I'm as sanguine as I could be from that perspective. In terms of teaching, look, we've had to be creative, right? Because here's one of the really fun things about this program. It's my favorite program amongst all the ones that we have for the following reason, which is, everyone who's doing an executive MBA is a bit older, a bit more experienced, a bit more senior, but also, you're often doing your professional responsibilities at the same time you're doing class. You've got, family responsibilities often as well, and it's sort of an interesting challenge, but also exhilarating for the students. And at the end of that, the students feel pretty bonded and such. But that has been a challenge in the Zoom kind of world, because your work's on Zoom, and then maybe your kids are around if you have them, or you've got then class in the Zoom setting. So we've been able to sort of kind of creatively break things out. So for example, here's what I've done. I've taken some things and built some pretty high quality short video content that allows the students to look at some of that at your leisure. And then what we do is we'll kind of get together in small groups, and we'll sort of take that those learnings as kind of given, and then really maximize the time that we have in an efficient way to have an interesting discussion and go through some really practical stuff. And then I've also done it in such a way where I've even just broken up the class into smaller evenings or over the weekend, and we'll just get together and kind of hang out and work through some material in a more intimate setting where not everybody is together. So that means kind of different touch points that kind of maximize the different opportunities for learning, but also get you off Zoom all day. And then give you a chance to, maybe if there's something a little more technical, I'll sort of put that into a video space. And so somebody who feels really comfortable with that can just rip through it. Somebody who wants to spend a little bit more time with that can review it. And then what happens is we get all levels set. And then when we meet in the kind of the live time, we can have a really productive live session where we can sort of take those maybe more theoretical learnings and sort of put them into practice and such. But it's been interesting. I've learned a lot myself. It's been kind of crazy to be sitting at this table, at my desk here for what now feels like a long time. But I think, there's definitely been some challenges for other parts of campus, less hours, and I don't know, if you were going to do a lab or something. I'm not sure how you do that in a physics class. If you're going to, sit around and talk about a piece of literature as a literature professor, that's challenging in a way too. But in terms of the business setting here, we've been able to experiment and come up with some things that I think have worked pretty well for a number of the students. Partially because we've been experimenting with this for years, actually. So like my evening EMBA class has some asynchronous components now for several years. So I've kind of taken the learnings from that and tried to adjust them on the fly and make this work.
Thank you.
Yeah.
What does the cadence of your class look like in a typical semester? So I understand there's in-person classes and then there's cohort work where we would do it together, but would you explain a little bit more about what that looks like, at least in your class that you offer?
Yes. So I have a class that is a core class, which is on kind of global economics issues like this. I kind of call that a macro for managers class, basically. That's relatively short though. So that meets only for a few weeks. And then I have a second year elective that I teach for investment management. And so that's a class that actually many students take. So I teach it in kind of two parallel tracks. One is for folks interested in that from a professional standpoint. And then also I teach it with a second kind of parallel track, which is for everyone else that wants to apply the tools that we're learning there to personal finance and 401k management. So I end up having a good chunk of the MBA class in there, even though only a subset are really finance students. So those are two really different settings. So the elective is longer. It spans over a few months, and we're going to meet either every few weekends or every few evenings depending upon the venue. And then whereas the macro class is kind of more bang bang. The way I have it is there's some spread out in between. So we'll meet every few weekends if it's the weekend venue. And in there will be, as I said, maybe some asynchronous content that you can kind of do on your own in the interim. And then there will be some group work that every professor is going to assign, because that's an important part of the learning, sort of navigating some of this and dealing with the group dynamic, as well as that's where a lot of the fun stuff, the networking, the friendships are formed as well. And so we'll have live class time. There'll be the interim period where you'll be working on some things that might involve some async work for me, that might involve some group work together. And that's going to mirror both in my elective as well as what you'd see in the shorter core class. Just the core class has less of it. And I think most faculty would have a format that sort of resembles that. And we try to be, the weekend, especially if we can be, live and get back to normal, in the Rizzo Center, that's relatively locked, buttoned down. You got to be there and do all of that. But everything that happens in the interim, in those intervening weeks, we try to set it up so you can navigate that with your teams, perhaps in a way that works around the other challenges of being a working professional. You want to add anything to that, Kara?
I was just going to add the other part. I know you talked about group work, but you're actually assigned a project team when you first start. And so you do all of your projects with that group throughout the core courses. And so as Christian talked about, that's where, again, the networking and relationships, all of that he mentioned. But I really like the fact that the director and the admissions team work together to form those teams, because ideally each team is comprised of various backgrounds and functions and industries. And so if you go into it knowing that maybe you are not the strongest in quantitative courses, you've got a good team that you can rely on, and vice versa.
Thank you.
Other questions?
In regards to the teams and developing them, I know you mentioned that the goal is to have people from different backgrounds, different areas that they focus in on their actual jobs. But with this whole COVID thing, would it be also a factor of relevance to where they are coming from? For instance, if you have somebody that's, in Michigan or some, a different state outside of North Carolina, is that a factor in developing the teams?
Hey, Brandon, that hasn't been in the past, but that could very well change, given COVID, like you said, just the accessibility about if you want to get together with your classmates in between those 3-week periods. But historically, it hasn't been a factor at all, just because everybody's on campus, every 3 weeks. I would say we definitely take time zones into consideration if it's significant. But again, the beauty of this, group is that you get into a rhythm and you find the best time that everybody can meet. You find out, a lot more about each other and what everybody else has on their plate. And so you kind of, all come together on a time that works for everybody. But I'm sure we are going to take that into consideration for February for sure.
All right, thank you.
Yeah. Any last questions? I know we're a little over time, but happy to hang out if anybody, any recommended readings in finance?
Yeah, so again, feel free to reach out to me on LinkedIn and connect over there, and I'm happy to continue the conversation. That'd be just fine. Happy to do it.
Well,
Thank you guys.
very
Appreciate it.
much. Yeah, thank you guys for coming. Christian, as always, thank you so much. I record this, so happy to send the link out to everybody if you want a copy of it. Also, again, we will be waiving your application fee for attending today, and then I will be hosting a webinar next Wednesday evening at 7 with Dr. Bill Faulkner, who will be your career coach through the program, and Anna Kearns, who is our financial aid director. So please feel free to join us then as well. But thank you all so much. Have a great rest of your week. It's almost Friday. And please reach out if you need anything.
All right.
Thanks, everyone.
Bye.
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 Thank you.